You're reading another article about investing at midnight, third one this week, and you're highlighting passages like you're studying for an exam that determines whether you get to retire or die at your desk. You know what dollar cost averaging is. You can explain the difference between a Roth and a traditional. You've got a spreadsheet that tracks your portfolio allocation down to the decimal, and you rebalance quarterly because that's what the smart money does. You've read the books, you've watched the breakdowns, you follow 4 different finance accounts, and you quietly judge your coworkers who don't know what an expense ratio is. You are doing everything right. And there's a woman in your building, Unit 4B, who you've talked to maybe 3 times. She works at a job you've never fully understood, something administrative, something that doesn't come with equity or stock options or a signing bonus. She doesn't read finance blogs. She doesn't know what a CAPE ratio is. She once asked you what an ETF was, and you explained it, and she nodded politely, and you could tell she was already thinking about something else. She invests in one fund. She doesn't know which one exactly. She set it up years ago, some target date thing her company offered, and she's never logged in to check it. Not once. She doesn't rebalance. She doesn't hedge. She doesn't have a strategy. She has a direct deposit that takes money from her paycheck and puts it somewhere she doesn't look. And she's worth more than you. Not by a little, by a lot. And if that fact makes something tighten in your chest, if there's a small, sharp feeling you can't quite name, something between confusion and injustice, stay with it. Because what she understands about money and what you've been avoiding despite all your knowledge are not the same thing. And the difference will cost you decades if you don't see it. Let's start with the lie. Not a small one. The central, load-bearing lie that holds up the entire structure of how you think about your financial life. You believe that understanding money is the same as being good with money. That knowledge creates results. That the person who reads more, studies more, analyzes more, will naturally end up with more. It feels so obviously true that questioning it seems almost insulting. But look around. Look at the exposed wreckage of people who understood everything and still ended up stuck. The day traders who knew every candlestick pattern and blew up their accounts. The finance professionals who can model discounted cash flows in their sleep but have almost nothing saved. The people in your own life, maybe you, who know exactly what they should be doing and still somehow aren't where they should be. Knowledge isn't the bottleneck. It never was. The bottleneck is something else entirely, something that the woman in 4B has in abundance and that you've been systematically destroying every time you open your brokerage app. Think about a garden. 2 people each get an identical plot of land, same soil, same sunlight, same seeds. Person 1 is obsessed with gardening, reads about soil pH, studies growth cycles, buys specialized tools, checks the plants every morning, adjusts the watering schedule based on humidity forecasts, prunes aggressively, repositions pots to optimize light exposure. They're in that garden every single day, hands in the dirt, measuring, adjusting, worrying. Person 2 plants the seeds, waters them on a simple schedule, and walks away. Comes back a week later, waters again. Doesn't check the pH, doesn't reposition anything, doesn't read articles about optimal pruning techniques. Just plants, waters, leaves. At the end of the season, Person 2's garden is thriving. Person 1's garden is a disaster. Not because they didn't care, because they cared too much. Every time they pulled a plant up to check the roots, they damaged it. Every time they moved a pot, they interrupted the growth cycle. Every time they pruned, they cut something that needed to stay. Their knowledge became interference. Their attention became destruction. The garden didn't need an expert. It needed to be left alone. Your portfolio is the garden, and you keep pulling up the roots. Here's where this stops being a metaphor and starts being something that should genuinely alarm you. Fidelity did an internal review years ago, a study that's been cited so many times it's almost become myth. But the underlying truth is real and verified across multiple data sets. They looked at which accounts performed the best over long periods. The top performers were accounts whose owners had either forgotten they existed or were dead. Read that again. Dead people outperformed you. People who could not, under any circumstances, log in and make a clever adjustment, who could not sell in a panic, who could not rotate into the hot sector, who could not do any of the things you spend your evenings learning how to do, they won. Not by a small margin, the gap was significant enough that it raises a question most people refuse to sit with. What if everything you're doing isn't just unnecessary, but actively harmful? What if your sophistication is the problem? What if the woman in 4B isn't lucky? She's just not in her own way. There's a specific moment that happens inside the mind of someone who knows a lot about investing, and it happens so fast, so automatically, that they never catch it. The market drops 3% in a day. The person who knows nothing feels a small ripple of unease, and then forgets about it because they're thinking about dinner, or their kid's soccer game, or literally anything else. The person who knows everything feels that same ripple, but then does something catastrophic. They contextualize it. They start running scenarios. They check what the Fed said last Tuesday. They look at the yield curve. They read 4 opinions from people who disagree with each other. They calculate their exact exposure. And now they're not just feeling uneasy, they're building a narrative, a story about why this drop is different, why this time the pattern is breaking, why they need to act. And the action feels rational because it's built on real knowledge, real data, real analysis. But the action is almost always wrong, not because the analysis is wrong, because the timing is wrong, because the emotional fuel underneath the analysis, the anxiety, the need to do something, the inability to sit still while your money moves in a direction you don't like. That fuel corrupts every decision it touches. You're not making a strategic move. You're making an emotional move, wearing a suit made of logic. And it fits so well, you can't even tell the difference. This is why the research keeps saying the same thing in different ways and nobody listens. Dalbar's annual study shows that the average equity fund investor earned roughly 3.6% per year over the past 30 years, while the S&P 500 returned over 10%. The funds didn't fail. The investors failed. They bought after things went up because it felt safe. They sold after things went down because it felt dangerous. They chased performance, rotated sectors, followed tips, made moves. Every move felt intelligent in the moment. Every move cost them money over time. The gap between what the market returned and what investors actually captured is not a knowledge gap. It's a behavior gap, and it's enormous. It's the difference between retiring with 1.8 million and retiring with 540,000 over a 30-year career of investing the same amount. Same market, same funds, same starting point. $1 million of difference, and the only variable was whether you touched it or not. Let me ask you something you probably haven't considered. What is your financial knowledge actually for? Not what do you tell yourself it's for. What is it actually doing in your life right now? Is it making you wealthier? Or is it making you busier? Is it giving you peace? Or is it giving you more sophisticated anxiety? Because there's a version of financial literacy that functions like armor. It protects you from scams, from terrible products, from not understanding your tax situation. That version is useful, essential even. But that's not the version most people are practicing. Most people are practicing a version that functions like a compulsion. They don't check their portfolio because they need to. They check it because they can't not check it. They don't research new investment strategies because their current one isn't working. They research because sitting still feels irresponsible. They don't trade because the opportunity is genuine. They trade because the alternative is trusting a process they can't control. And control is the thing they actually crave, not returns. The woman in 4B doesn't crave control. And that's not because she's naive. It's because she never built an identity around being financially sophisticated. She doesn't walk into rooms carrying the invisible weight of needing to be the person who understands markets. She's not performing competence. She's not trying to justify her choices with data. She made one choice years ago, a boring one, and then she directed her attention to the parts of her life that actually respond to effort: her relationships, her work, her health. The things that get better when you show up every day, not her portfolio, which gets better when you don't. And here's what happens over years when someone lives like that. Something shifts that has nothing to do with money. Their relationship with uncertainty changes. They develop a tolerance for not knowing how things will turn out. They stop needing to predict the future to feel safe. They stop needing to be right. And that tolerance, that willingness to exist inside uncertainty without reaching for the lever, that's the thing that actually creates wealth. Not the knowledge, not the strategy, the patience. And patience isn't a skill you learn from a book. It's a skill you develop by practicing the almost unbearable act of doing nothing when every instinct tells you to move. Now something starts to change in how you see yourself and everyone around you. You start noticing the pattern everywhere. The coworker who's always talking about his latest trade. The one who sounds so confident, so informed. You realize he's been doing this for 8 years and his net worth hasn't moved meaningfully. He's not investing. He's performing investing. The friend who switched to a new robo-advisor because the old one wasn't optimized. Who changed her allocation because she read something about emerging markets, who pulled money out in March of 2020 and put it back in 6 months later after the recovery was already priced in. She's not managing risk. She's managing her anxiety. And you. You're starting to see your own reflection in them. Every time you rebalanced, was it because your allocation had genuinely drifted beyond acceptable parameters? Or was it because rebalancing made you feel like you were doing something? Every time you sold a position, was it because the thesis had fundamentally changed? Or because the red number on the screen made you feel like you were losing? Every time you researched a new fund, a new approach, a new framework, was it because your current approach was failing? Or because the silence of a working strategy felt too much like standing still? The identity shift here is quiet, and it's devastating, because you start to realize that the thing you were most proud of, your financial knowledge, your discipline, your engagement with your money, might be the thing that's been holding you back. Not entirely, not always, but often enough that the gap between where you are and where you should be has a name. And the name is intervention. You intervened. Again and again, with intelligence, with good intentions, with real information. And every intervention had a cost that was invisible in the moment, but enormous over time. 1% here, 2% there, a badly timed sell, a tax event you didn't need, a missed recovery because you were on the sidelines being careful. Multiply those micro costs across years and decades, and you're looking at the difference between freedom at 52 and obligation at 67. Not because you didn't know enough, because you knew too much to leave it alone. Here's where most people hear all of this and make the exact wrong move. They decide to become aggressively passive. They announce to themselves, or worse, to other people, that they're done trading, done checking, done interfering. They make non-interference into a new project. They set up the automatic investment, delete the app from their phone, tell themselves they'll never look again. And it works for about 6 weeks. Then the market drops, and they hear about it from someone at work or see a headline they didn't mean to click. And suddenly the anxiety is back. And they don't have the app, but they have a browser. And they're typing in their brokerage URL and checking, just this once. The problem was never the app. The problem is the belief that your attention is required, that the system will fail without your supervision, that the market is a machine that requires an operator. It doesn't. It never did. And every moment you spend watching it is a moment you're not spending on the things that actually need you. Your career, your skills, your relationships, your ability to earn more, which is the one financial lever that actually responds to effort in a linear way. The market doesn't reward your attention. Your career does. Your business does. Your network does. But you've been giving your best cognitive hours to the thing that performs best when ignored, while neglecting the things that atrophy without engagement. The allocation is backwards. Not your portfolio allocation, your attention allocation. The woman in 4B isn't smarter than you. She's not luckier. She's not more disciplined in the way you think of discipline. She's disciplined in a way that looks like indifference from the outside. She is disciplined enough to not care, disciplined enough to not look, disciplined enough to let a machine do what machines do, while she does what humans do. And 15 years from now, maybe sooner, the gap between her outcome and yours will be visible, and it will be hard to explain to yourself. Because you did more, knew more, tried harder, and ended up with less. Not because the world is unfair, because you confused motion with progress. Because you thought the opposite of ignorance was mastery, when the opposite of ignorance, at least in this domain, is just enough knowledge to set it up and the wisdom to walk away. Remember the question from the beginning. How is she worth more than you? How did the person who couldn't name her fund outperform the person who could explain modern portfolio theory at a dinner party? The answer was never about returns, or strategies, or secret knowledge. The answer is that wealth isn't built in the moments you're watching. It's built in the moments you're not. Every hour she didn't spend researching was an hour her money spent compounding. Every decision she didn't make was a mistake she didn't make. Every panic she didn't feel was a sell she didn't execute. Her ignorance was a shield. Her disinterest was a strategy. And the most sophisticated thing she ever did was nothing at all. You're still reading articles at midnight. She's sleeping. And her money is working.